Over the past few weeks, we've seen not just tax reform, but what you could potentially call tax whiplash, with measures announced, backlash triggered, carve-outs, and even some apparent backflips. And this week, we're asking, well, what does this mean for estate planning, for your legacy? Today, I am joined by Brent McCartney once again from DFK Benjamin King Money. Welcome, Brent.
Thanks, Simon. It seems to be a weekly occurrence at the moment.
There's a lot happening, especially with the tax reform side of things, for sure. Now, on that, of course, this is a general discussion. It is not personal tax or legal advice. But what we do want to do today is set you up, help you out to know what questions you should be asking your advisors, your accountant, your lawyer, your estate planner, given what has been happening in the tax reform environment lately. Let's kick off today, Brent, with what actually happened. So in the budget that came out on the 12th of May, they proposed a 30% minimum tax on discretionary trusts to kick in from 1st of July 2028.
Yeah, 2028, yep.
That was one thing, but then concerns started to emerge around whether a thing called a discretionary testamentary trust was going to be caught up in that, particularly newly created testamentary discretionary trusts were going to be caught up. And a lot of critics started labeling this as a death tax, which sounds very disturbing, or a death duty by stealth. Brent, is this really a death tax, or is that just political spin?
In a way, it is a death tax because it means your estate planning or your money that you want to leave in testament for your family would have been subject to the 30 cents tax. So when the rules came through and said 30 cents tax on every trust, it did incorporate testamentary trusts. Hence the backflip. I know the negative gearing's gone through. I know the capital gains has gone through. But in terms of the trusts, and accountants and accounting associations have been nitpicking and looking at all different kind of situations, with the first one being suddenly testamentary trusts are taxed at 30 cents as well, because they're seen as a trust, a discretionary trust, falling under those original rules of a minimum 30% on the income.
Okay, so we'll get into what a testamentary trust actually is in just a second.
Yeah.
But what happened? So the government actually did back down in relation to these testamentary trusts, didn't they?
Yes, they went back and said, you're 100% correct. And what they also had included in the original testamentary trust that one of my business partners put me onto is that when you have a testamentary trust, that if you were to change investments in your testamentary trust, sell a property, sell shares and buy new shares, that new investment was going to be subject also to 30 cents tax, not grandfathered like the other income. So
Right.
Even in your testamentary trust, where you would have changed an investment to a new investment within it, you would have had to split rules, because when the rules come through, the current testamentary trusts in place were grandfathered, but future testamentary trusts were subject to 30 cents tax. What they also had within the writing, and people pointed out that in your current testamentary trust, if you changed an investment, bought a share, bought some other shares, managed funds, whatever, that new investment would be subject to 30 cents tax.
Sounds very, very messy.
Like I said, it's almost, here's a blanket rule, and people are going, what about this situation, this situation, this situation? And they went, oh, we hadn't thought of that. Let's go back and go back to the original rules of how testamentary trusts are taxed.
So back to right down on that.
Yep.
Now, there's a separate issue we might chat about today as well that came out recently, this whole idea of widows or divorcees potentially losing grandfathered treatment on jointly owned assets after a transfer of ownership that's been caught up in some of the original writing around these changes as well. We'll come to that in a little while, but the key here is that this is where tax reform really moves from just policy theory, and I think the government's discovering this. It moves from policy theory into having real family consequences that people will feel. And I think that's caused a lot of the controversy around all of this. So let's do a little bit of a testamentary trusts 101, because I think before this blew up, a lot of investors weren't even familiar with testamentary trusts unless they already had one. So Brent, can you explain it in plain English what a testamentary discretionary trust actually is? What is that?
Yeah, so what a testamentary trust does, it really is an asset protection mechanism. So on death, rather than your assets go to the estate or through your will, they're held in testament for your family and future generations. So one of the big things about it was that asset protection. So on death, rather than your assets go to family members and they're in trouble or they're subject to having to pay debts and things like that, they're put into a testamentary trust where the beneficiaries only get access to the income it derives. So it's almost that protected mechanism to go, here's my inheritance, which might be made up of property, cash, investments. Rather than give that out to straight to the beneficiaries of the estate, it's held in testament in a testamentary trust for future generations. So it's almost what we said is it's for asset protection. It's also to allow legacy of your estate to future generations. So not going out straight to the original beneficiaries and then wasted or spent, but more going to testament that it's there forever to actually be invested for future generations.
Right. So is there a certain element of we don't necessarily trust the beneficiaries in this instance, so that you want the trustee to remain to retain
without
some control?
getting cliched about it, what accountants say, it's almost managing your estate from the grave.
Right.
I've got this wealth. I don't trust you with it straight away. So I want to put it into a testamentary trust and have executors run that wealth that I've accumulated on your behalf rather than give you the check at the end. But what it does come down to is a great tax minimization tool. So the advantage of that testamentary trust is any income derived can be distributed to beneficiaries at a lower tax rate. But the kicker with a testamentary trust was that you could distribute to under 18s. So with your normal trust, you have to be over the age of 18 with a tax file number to distribute any profits to. With a testamentary trust, you can actually distribute to under 18s, minors, grandchildren, and they're taxed at their marginal tax rate. So it's a great tax minimization tool to go, well, I'm a high income earner. I've got a big business. I'm on a big salary. My inheritance comes through. I want to keep and invest in the inheritance. And I can get that income through to my younger beneficiaries that I can't get the income to. So it was a great, as well as being that asset protection and a legacy tool, it was a great tax structure to minimize tax. We can use beneficiaries under the age of 18 to minimize the tax bill.
How do you create one of these testamentary trusts? What's involved in putting one together?
So you have to contemplate it in your will. So when you're going about doing a will, you have to ask that on death, a testamentary trust is established with your assets, with your investments, with your estate moving to the testamentary trust, and then appointing executors to run the testamentary trust on behalf of those beneficiaries. Now, that could be your adult children. A lot of the times, and I run a few estates as well, it could be your accountant, your lawyer, a friend, a trusted friend. So it's that, like I said, it's that layer, without saying the cliches, to go, I've got $1 million estate. I'm not going to give it to you. I'm going to put into a testamentary trust and protect it so you can get the income from it. So it's about that control from the grave. It's about minimizing the tax, but it's also making sure money doesn't go out and be spent. Money doesn't go to someone who's in a struggling business and absorbed by someone else. It also can be that you might have children you don't trust their partners. So you put it to a testamentary trust. So it's not like you give them the check and they break up the next day and they take half the estate.
Right.
That's where that comes down to that manipulation of saying, I'm controlling from the grave. I don't trust you, but I trust someone else to keep that assets to produce an income stream. But it's a great tool, especially for a large estate.
It only comes into effect, though, after death, doesn't it? In the meantime, it's just kind of sitting there dormant.
Put in place when death comes. So your assets go into your testamentary trust. Now, when we say that and say that assets, they're assets like company shares, investments. It can even be your superannuation proceeds. Obviously, if you've got an existing trust, the trust goes to go on a testamentary trust. The trust can continue.
Okay, so what's the difference between a fixed testamentary trust and this discretionary testamentary trust?
Like a unit trust, your entitlements are fixed. So what the benefit of that testamentary trust is that you can go and have that discretion distribute over the family group. More importantly, to your children under 18. If you're going to fix it, that's even more control from the grave, where you decide to go, the income it derives, you're going to get this amount of capital at a certain age and a percentage of the income each financial year.
Right.
Obviously, as an accountant, we would encourage, similar with discretionary and family trust, discretion to distribute the profits all over the group, because we want to have that control
in terms of the tax planning, tax
and
management.
the tax planning, and also the discretionary trust. What you can built into testamentary trust is when your beneficiaries hit a certain age, you can make capital payments out to them. So you can see it can also be very important with younger people or with younger children, that they've got someone controlling their estate till the children are ready to deal with the money side of things or to use the capital.
So essentially, a testamentary discretionary trust then is basically a structure that's built into your will.
Yep.
And it gives the trustee who's going to control that trust after you die flexibility about how the inherited assets and income are managed and distributed to the beneficiaries.
Exactly right.
After you die.
With the trustee having to keep the corpus. So they've got to make sure that the corpus still is in existence and produces an income stream. So there's a lot of pressure on an executor of that testamentary, or a trustee of the testamentary trust, because they can't go and invest riskily. They've got to keep the corpus. So if there's $1 million to start, they've got to keep the $1 million, and they can either pay the profits out or reinvest the profits it makes each year, but they've got to keep the corpus safe.
If we look at why a property investor or business owner would want one of these in their will, I mean, obviously there's potential tax benefits in terms of what happens after you die and who receives the money and how much tax they pay. But other reasons like asset protection, we've talked about, maybe protection in relationship breakups and that kind of thing. Are there any other sort of key benefits in your mind as to why an investor or business owner would want to put one of these in place?
It's absolutely that. It's that asset protection to keep it from beneficiaries, creditors, and bankruptcy. It's to help children who mightn't be too young or sophisticated, especially with maybe special needs kids that just won't have an understanding. Like I said, you can control your inheritance to make sure that your legacy is continued. So obviously the hardest thing is for any property investor is you have a long-term property. You don't want it on death to be sold and moved. You want that property to have a tremendous legacy for future generations. If you have those properties in your own personal names, including your main residence, you might want to have a legacy to keep them for 100, 200, 300 years.
So it's not just about tax. There are bigger reasons here in terms of control, protection, flexibility, and so on.
Yeah, I mean, a lawyer will tell you why, but like I said, it's that having the control and not, unfortunately, and my kids would be the same, is if I'm passing away, what would they do with $500,000 or $1 million or $1.5 million? But making sure that actually I'm in a position where I might be older, I want my grandkids looked after or future generations. So you might have the testamentary trust being established to support them in schooling and things like that.
Comment in the chat, coming back to the fixed versus discretionary testamentary trust arrangement, that when it's a fixed trust, then the beneficiaries have a present entitlement. So it's a defined entitlement. So it's not necessarily as useful for things like asset protection, for example, in bankruptcy or divorce, like we've been talking about. So that discretion is valuable. All right, so let's talk briefly about why this blew up as such a big controversy. You had the government that was taking the line that discretionary trusts can and have been used for income splitting and tax minimization, and they didn't really like that idea. And they wanted trust income to be taxed more consistently with how wages are taxed. And so that's been a big part of what's behind passing these reforms. Why did the 30% trust tax trigger such a strong reaction from estate planning advisors, do you think, Brent? What got people really concerned about that fundamentally?
I think, for one, it wasn't contemplated in the blanket 30% of all trusts, and people going, hang on, I've set up a testamentary trust not to minimize tax, but to protect my assets and to have my future generations make the income. Suddenly, if you're using 30% of the income each year, it becomes more of a tax drain. So if we look at it, it might have been that the testamentary trust had a lower lifespan because of the higher taxation that it'd have. And more so that if we look at the rules where previously for both a testamentary trust and a discretionary trust, the beneficiaries taxed, the trust is suddenly taxed. So suddenly that 30 cents tax is absorbed in the trust, which means you've got to produce income to pay the 30 cents tax, which might be a drain on that original corpus.
Which then impacts what you can pass down to future generations.
Yeah, exactly right. And even in terms of that estate planning, when you may have bulky assets like property, it might have to sell property to pay the tax.
So we've got a whole pile of unintended, at least unexpected consequences for families that might be dealing with death, with disability, divorce, vulnerable beneficiaries, a whole pile of things that weren't considered when this was rushed through that naturally created this concern, this backlash that we've seen. But the government did back down. And again, highlighting the problem that when you do this broad brush tax reform, it hits tax planners like yourself, Brent, but it catches out ordinary families, and everyone gets caught up in the blast radius when things are rushed through like this without adequate consideration. All right, so that's the discretionary testamentary trust. The other thing that blew up in the last couple of weeks was this whole idea of a widow's tax and concerns about that, and then what appears to be maybe a backflip on this. What is this widow's tax, Brent? Can you explain to us simply what the issue was?
So in the I believe what the widow's tax was on death. We'll talk about the widows, or even on divorce, when there's a change of ownership, that ownership has a change of rules on that asset. Now, if we look at why is that important, if partner and partner have a negative geared property, one passes away and inherits a new 50% share, the negative gearing on their portion disappears.
No grandfathering because it's transferred.
No grandfathering, exactly right. And also changes around the CGT discount where they would have had a difference in the CGT discount. So generally what would happen is partners have a property currently negative geared that, depending on the estate planning, on death, if it's joint tenants, it might go to the other spouse and they'd continue having that property. Obviously what the widow's tax said is it's a change of ownership, the rules change. So suddenly, and that becomes...
It's like a brand new purchase, effectively.
It's a brand new purchase, even more so that if it was not even a joint asset, but it was partner owns 100%, transferring it to the other partner, they would have the new rules. So say, for instance, me and my spouse I have an investment property 100% in my name, negative geared with the 50% discount. On my death or on my divorce, if it got moved to my spouse, the rules change again. Incorporating what you would have bought it and not have the negative gearing. So suddenly, like it was, negative gearing might be part of my retirement, and on death it shakes it up again.
Yeah. And divorce as well. So anything where there was joint ownership became a concern here, didn't it?
Yes, exactly right. Yeah. Or even if you've contemplated the property tenants in common goes to that testamentary trust, the rules change in the testamentary trust as well. So didn't look at what happens on that death type stuff.
Yeah. So what we've seen in the last few days then is the government appearing to say that, oh no, we're going to deal with this. It's going to be fine, and we'll deal with the issue later in legislation. So we don't actually know how this is going to be addressed at a detailed level, do we? We've just got kind of a promise that it will be addressed. Is that fair to say?
Yes. So promised corrective legislation to protect affected individuals.
Why not just get the legislation right the first time through anyway? All right. So the idea here is that in both of these situations, the discretionary testamentary trusts and the widow's tax, there's been a reversal, or at least a promise of a reversal, in order to maintain the status quo effectively for those. But it has kind of brought these things into the light that people might not have thought about previously. Brent, from a practical perspective, let's talk about a few key questions people should maybe be asking their advisors right now. What would you want clients to check if they currently own property jointly with a spouse?
Any joint assets in a spouse, even your own home, you should have a will. If you've got businesses, trust, where you're directors and maybe the spouse is non-directors, you should have financial power of attorneys in place. So it is a very grown-up conversation to go, what happens on death? But as soon as you're outside the norm where you're buying property, buying investments, setting up companies, setting up self-managed funds, that is really a ticking point to go, I need to establish my will and look at the whole thing through.
Yeah, and make sure your structure still makes sense under the proposed rules, at least as far as we know them at the moment. I guess checking things like whether your will does currently include a testamentary trust and whether it's fixed or discretionary would be part of that assessment as well, wouldn't it?
And whether a testamentary trust is the right structure moving forward. Because some of the other contemplations on, without confusing the conversation today, is your own assets become part of your will. Your superannuation doesn't have to form part of your estate. Because under superannuation, whether it's an industry fund or a self-managed fund, you can actually input death nominations, so the money can go directly to beneficiaries. So even in terms of that's worth reviewing every 2 or 3 years due to change of circumstances. More importantly, when you're young, starting out work, setting up super, you've probably got mum and dad as your nominations. But as you get married, your kids get older, they should change on a regular basis.
So if you haven't reviewed your will in some time, now this is kind of just bringing it back into the spotlight that maybe that's overdue.
Yeah, and then either contemplating where you're at and how your money wants to be left in the estate, or whether the testamentary trust is still the right structure for your estate moving forward.
Tax rules change, they are changing. Governments can change as well. But structures that look like they were your perfect structure 5 years ago might not be the ideal structure now or moving forwards at the moment. So we might need to review those. The goal isn't to chase loopholes or try and save tax. It's to build your structures that are robust, flexible, properly advised by people like Brent to make sure that they are providing you with the tax management options, the protection options, that robustness that we really need. So Brent, if people want to get in touch with you, what's the best way to reach out and get in touch?
Definitely call me. My direct number is 9098 4208.
That's 03 for Melbourne, yeah.
03 for Melbourne, or on my email, brentm, BRENTM, @dfkbkm.com.au.
Awesome. Well, thanks again for all of your time and coming back and talking us through this messy, sometimes complex and confusing area and helping us to wrap our heads around it. For those who are new to the community and are joining their first Fireside Chat today, welcome. This is actually why we run the weekly Property Pulse Fireside Chat. It's to help investors cut through the headlines, cut through the noise, and understand what really matters. So make sure you've completed your profile. If you're new, answer the icebreaker question to introduce yourself to the community. Also, check out the recent replays, including previous Fireside Chats and other webinars that we've done, and book yourself in RSVP for the upcoming online and physical events as well. That's our Property Pulse Fireside Chat for this week. We'll be back again next Thursday. Thanks again, Brent. Pleasure to have you on as always, and look forward to catching up with everybody again soon. Thanks, everyone.
No worries. Thank you.